Hey everyone, this is Kirk here again at Option Alpha, and just doing a quick video update. It's Monday, February 6th, after the market close. So I wanted to go over some technicals here on the charts. I know that this crazy melt up in the market has been driving people crazy, and so just want to go over some technicals, maybe give some guidance and some things to think about, some things to watch out for that you may not have looked at on other charts. The first thing I want to do is overlay here. Oops, switch back from Bloomberg. Is overlay some of these technical indicators that I've put on the chart here in accordance with the S&P. So I've just taken a snapshot of the S&P for the past 6 or 7 months here, and what I've done is actually overlaid the Aaron midpoint technical indicator. What's key about this indicator is that it actually signals, or is a pretty good indicator to use to identify trends. And the key with this particular midpoint indicator is that it's not the actual overbought or oversoldness of the indicator, it's the cross of this zero barrier here. That's really what determines a signal. So again, it can stay up in this over 50 range, in towards 100. It can stay up there all day, which it has been doing for the last month and a half. It can stay down here below 50 all day, all long. But what the key is here is the cross, where I've drawn these X's on the chart. So if you actually look, it's actually not bad at predicting some of the more harder falls and rallies that we've had, namely here in August. If you got out right at the cross of the midpoint below zero, again, that would have kept you out of the monster drop that happened 4 days later. And then here and there, you would have been in and out, obviously. More recently, you would have been in the big market rally that we've had from the midpoint of December. You actually would have been in about 2 or 3 days ahead of time, which is actually pretty interesting that it crossed above that barrier right before the market actually really took off. So very much a leading indicator, at least at that point. What I wanted to drive home and really push through tonight is that you can see that most of these indicators have not turned over yet. And we'll look at some more, some that have, and some that have started to turn back up. But even when you look at things like the Aaron midpoint here, you can see that it's still very high. And again, the key isn't with this one that it's necessarily high or low, is that we need to see this come back down and cross over the zero barrier. And we need to see it cross lower to signal that a trend change is at least coming or has already started to happen. Now again, we could definitely see the market turn over, and it would turn over before this crossed. But right now, we are definitely in a very stable, what looks like to be a fairly strong upward trend. There's really nothing stopping this right now, unless we run into some resistance here in the next couple days. If we look at things like the MACD with my lines here, as always, you can see that we actually did have a cross of MACD back a couple days ago. And what I think is usually the most important, and I'll just really extend this MACD here below so I can really drive home the point. But I always say that the most important point with the MACD is this cross, this black line crossing underneath of this red dotted line. That really gives me the signal. You can always look at divergence, and you see we had some very clear divergence in the market heading into January and heading into February. And we did get that cross, which was a sell signal. But notice how it's come right back up and given us another buy signal here just recently. It's not even really wasted a week or so during this time period and already given us a buy signal. So for those of you who are short traders, who trade the market short, buy puts, sell calls, this is where you really want to exit that position that you were in. If you entered the position here, which was a good entry, trust me, I believe you, that was a really good entry. You definitely want to be out of the position or at least hedging it here. And that's the real key to take away from tonight. Again, this has been fairly good at calling some of the more important swings in the market, namely right before the market rallied in late December, had a very strong cross, and the market just took off from there. Again, if we look at just the indexes on a technical note, let me go over here to my base chart. I think what I see across the board is that the S&P, the Russell, the Dow, all of them are coming into a very, very strong area of resistance. I mean, we're practically there right now. So as much as I look at all these indicators and think that they're continuing to show us higher prices, at least that the trend is going to continue, I find it hard to believe that we're going to bust through this massive area of resistance and not look back. We've gotten some good movement in the market. There's no doubt about it. We've crossed some pretty strong resistance already on the S&P at about 1275. I think it would be absolutely healthy and needed for the market to retrace most of this move and then continue higher from there. I think that any type of move that we continue up at this rate just looks like a moonshot. And the higher we go, the faster we fall. So if we want to sustain a strong bullish trend, again, I think it's healthy for the market to start turning over here, at least start trading more sideways, and come down and retest this 1275 area, and then continue to go higher or sideways or whatever it wants to do. I'm not convinced that this is going to last much longer, but then again, I haven't been convinced the entire month of January, and here we are. For our portfolio, we've been doing fairly well and staying away from the market. We've been selling puts on the RUT, on the SPY. We're going to start selling more puts this week, and I think it's going to be really good to stay in front of this thing and just let the market come to us, I guess. If we take a look at the VIX real quick, no real story there other than the fact that it just continues to make lows. We dipped down into the mid-teens earlier today on the lows, but we still managed to come back up here above 17. I think if we get anywhere towards 15, then I'd be a buyer of VIX calls for the next couple of months, because I think even a quick spike up in the VIX is going to be very, very profitable. So if we do get down into the 15 area or below, I would absolutely be a buyer of VIX calls. I think that any type of long volatility strategy is going to work out really good there. And if nothing else, just use it as a good opportunity to hedge your portfolio. Start buying some puts on either end of your credit spreads because they're really cheap right now with volatility so low. And you want to hedge those credit spreads and those negative puts and calls from any sort of Vega exposure that we could have should the VIX start shooting up towards 25-30. So that's really where we are in the markets. Sentiment-wise, I think that all the news all over the place is different, and you can see where it's at. But most people think that it's overbought, that it's not going to continue. But we've seen this story time and time again where the market just continues to roll on through, regardless of what everyone thinks. So, as always, take a look at your indicators. Be mindful of what they're saying. Listen to them. Don't try to outsmart the market. Just trade with the trend, identify things early, and follow your instinct, really. So hopefully this has been a good video. As always, I enjoy your guys' comments, so add your comment right below to this video or to the post, and share this video, of course, if you enjoyed it on YouTube and Facebook.